everyone. I'm Justine Loo, a managing broker at Rennie, and today we're going to be shining the spotlight on our most recent intelligence publication, our fall 2022 edition of the Rennie Landscape, which is also known in the industry as the Little Red Book. For those of us who are less familiar with it, the Rennie Landscape is a semi-annual publication that our Intel team produces and tracks a variety of factors that directly and indirectly impact Metro Vancouver's housing market. Today we're going to explore how we got to where we are today, what it means when we say it's windy, and what we know about what's ahead of us. With me today is Ryan Berlin, our Senior Economist and Director of Intelligence at Rennie, and Ryan Wyse, our Senior Analyst with our Intel Division. Welcome.
Justine, right? It's good to be here.
Mm-hmm. Good to be here. Good to be in our new setup in our new office.
Yes, very exciting.
It is, yeah. And then literally 10 minutes ago, the printed version of this edition of the Rennie Landscape just dropped. Actually happened.
I know,
and
fresh off the
very
press.
Exciting. Yes,
very
right
exciting.
in front of us here.
Mm-hmm. New location, new landscape. So before we get started, let's talk about what the Rennie Landscape is.
Let's do that. Yeah. So the Rennie Landscape was, as a concept, was born 4 years ago. And it was born out of this idea that there's an increasing amount of data out there on everything, including our housing market. We knew then, and we know even more now about sales and listings and prices, but it really begged the question, if those are the what's of the market, what about the whys? So, why are sales going up? Why are prices doing what they're doing? And really all of that stuff is related to factors that are largely outside of the housing market. Things like demographic change and economic evolutions, labor market dynamics that are prevailing at a certain point in time, trends in financial markets. And so we thought we should be evaluating those things maybe a little bit more formally and bringing them together a couple of times a year, and that's where the landscape comes from. Mm-hmm. We found it to be very useful as a contextual piece of understanding what is impacting our market. And it's interesting, like the way that we consume information these days, increasingly, I think, is it's when we're on the go, right? We're doing other things, like we're watching TV or we're exercising or we're cooking or we're cleaning or we're hanging out with our kids. Mm-hmm. But we're always doing other things. So to get our attention, news outlets and anybody who wants you to consume what they're providing or what they're saying is, having it come at you, fast and furiously, right? And so we're inundated with statistical tidbits and headlines. And that's often how a lot of us sort of gain some semblance of understanding of the world around us. But headlines are called headlines because they give us headlines, lines in our head. It's often, there'll be dramatic statements, incomplete statements. And for a lot of people, that is what sort of supports, a particular perspective on a topic. And what we do at Rennie and broadly, and then within the intelligence team, is really try to avoid disseminating that type of information. So, as a research team here at Rennie, and for this company that operates within the real estate space in Metro Vancouver, we really strive to produce objective, as unbiased as possible, research into what is happening in our market, so that we just collectively gain a better understanding. And all of that kind of culminates every 6 months in this Rennie Landscape.
That's great. So when I look all around, we see so much that's going on in our economy and our housing market these days. How did we get to where we are right now?
Yeah, it's been a trip. So 2.5 years after the pandemic started, and I'm happy to be doing podcasts that aren't centered around COVID and the pandemic and how it's impacting us, but that has really informed our journey to this point, right? So certainly it's not one thing that has brought us to where we are right now. It's many things. The pandemic, which came out of the blue, which really no one predicted with any kind of, headway, it sort of landed in our laps and had a lot of lasting repercussions for us. So it wasn't just one thing that brought us to where we are today. It was many things, right? There was COVID, obviously, and the associated lockdowns and shutdowns and the like. But we've had supply chain disruptions, weather has even come into play. Last summer, we had this atmospheric river that I've never heard of that term before. That became very familiar, came through BC and caused major flooding throughout the province, disrupted supply chains on top of the disruptions that already existed into the Fraser Valley. But even, I think, out to the Shuswap Rye, where you have a cabin, you were saying that to this day, 2 of the bridges are still closed.
Yeah, they're not even closed. They're gone. The 2 bridges on the Coquihalla are still missing.
Right, they're gone.
They're working night and day to fix them, but they're not there right now.
Yeah. So, fortunately, a lot of what was ailing us during the depths of COVID is largely in the rearview mirror, but there's some sort of legacies effect of the pandemic. And I think one of the most prominent of those is this persistently high, very high inflation that we're all experiencing. And, that comes from a few different places. Obviously governments were supporting households and businesses through the very worst part of the pandemic to make sure we got to the other side, knowing that, the worst of it was probably going to be temporary. So how do we make sure everyone can get through this to the other side together? And we knew there might be some repercussions of essentially printing money. Now we're starting to see some of that, but that wasn't the only thing, because supply chains were disrupted to an extent that we didn't anticipate that we'd still be talking about this 2.5 years later. But of course, interest rates were driven to rock bottom levels. The Bank of Canada took their policy rate down to effectively 0%, and then they engaged in something called quantitative easing, where essentially they drove longer term interest rates down as well. And that's where we got to see the 5-year fixed mortgage rate of 1.5, 1.6%, sort of middle or early 2021. So now we're dealing with inflation around 7%. Certainly not just a Canadian phenomenon. We're seeing it all around the world, but it is something that we're trying to collectively tackle. And so with high inflation and rising interest rates and the housing market slowing down and all eyes on the labor market, the winds in the economy and the housing market are definitely swirling right now, and it feels pretty stormy out there.
So what was that metaphor you had about a plane in a storm? I can't remember.
Yeah. So this is something that was conceived of in the heat of the moment over dinner after a glass of wine when thinking about the real estate market. When there's a big storm, planes might be okay to fly through the storm, right, to get where they're going, to endure a little bit of turbulence, knowing they'll get to the other side. But when there's a big storm, planes may not be as inclined to take off. Right. So you go, how does that relate to our market? Well, I think right now it's very stormy out there. If you are an existing homeowner, if you're a developer who is currently in the midst of selling homes in a project that you plan to build in the future, or if you're actually building homes now, you're trying to push through this to get to the other side, right? So you're flying through the storm and you're enduring the turbulence. But I think if you were somebody, or you are somebody who's thinking about making that, once in a lifetime purchase, like buying a home or even selling, if you're, maybe you're downsizing for the only time in your life and you want to get it right. Or if you're a developer who is thinking about, launching a project into this market, maybe now is not the time. And we are seeing that. We're seeing some delayed participation for sure.
So that's some context for how we got here, but where is here, and how could you characterize the current landscape?
It's windy. I think we're talking about it's windy out there. Back to the storm analogy. And we can't really, we can't sum up our current environment with a single headline or a single stat or easily. There's a lot of different sort of swirling winds around it. We like to talk about headwinds and tailwinds and how they affect our market, but there's all sorts of crosswinds. Things are changing really quickly. It's like we're in the eye of a storm, and plenty has changed in the last 6 months since we did the spring landscape.
So it seems like there's quite a few turbulence down the way, but can you elaborate a little bit more on this?
Yeah, sure. Let's bring a few examples to this. And I think, we really should start with our labor market. I think when people think about how they interact with the economy, it always starts with the labor market. And we have a very tight labor market today. We have a very low unemployment rate nationally at 5.4%, locally at 4.8%. That's historically quite low. People who want to work typically are finding jobs in this market. And that's really a tailwind for our market. It's a really positive thing. But once again, I think this headline number, it doesn't tell the whole story of what we're dealing with here. We also need to look at things like the job vacancy rate. And this is kind of a relatively new stat that StatsCan started only tracking back in 2015. So we don't have a huge sort of historical series to go with it. But we're at a record high for job vacancies, both nationally in Canada, here in BC. So we looked at this ratio of how many vacant jobs there are to how many unemployed people are looking for work right now. And that ratio in BC is up to 1.35, which means there's way more job openings than workers. So here in BC, that's about 4 jobs for every 3 people looking for work, which I think is pretty telling.
Yeah, I mean, there's so many different ways you can slice this, right? So yeah, another way to look at it is that if every single unemployed person in this province right now took one of those unfilled jobs, there would still be 46,000 unfilled positions across the province. So, no matter what way you slice it, we have this imbalance in terms of labor supply and demand.
Yeah, when you put it into context like that, you can really see the big picture.
And it's
more clear.
Yeah, I mean, and the thing is, the vacancy rate is very high across the board, but it's uneven across sectors, and that's having differential impacts on sectors. The construction industry, for example, has a job vacancy rate of over 10%, which is, I mean, it's great that the intention is there to hire, but the positions aren't being filled. And that is in turn driving up wages. So we're seeing wages currently go up on a year-over-year basis by 3.2% in the construction industry. It may not sound like a lot compared to inflation, but it's a relatively elevated value.
Yeah, there could also be some other sort of incentives that employers are offering to sort of entice people to come work as they are having trouble hiring. We're looking at this work from home data. The big topic is, do people go back to the office or the workplace? Do they keep working from home? And most people nationally actually aren't able to work from home. It's about 57% of Canadians can't work from home, but it's much lower in BC. A lot more people have the flexibility in BC to work from home. So maybe that's an example of these employers trying to fill these vacant jobs and making it, offering a little bit more flexibility here in BC. So about 52% can't versus 57% nationally.
That's very interesting. Of course, what everyone seems to want to be talking about these days is inflation and interest rates. So can we talk more about that?
Yeah, sure. So Berlin was talking about sort of that headline inflation and some of the effects of the COVID monetary policy. But I think, again, that sort of headline inflation, which is 7% year over year, very high. But that's not really the only thing to watch here. As inflation brings up interest rates, I think there's a lot more to look at. Again, when we talk about interest rates, there's still about 2/3 of Canadians have fixed rate mortgages versus variable. And when we look at what they're up against, they're sort of anyone who, say, bought 5 years ago, who's coming up for renewal, they're facing a really big increase in their potential interest rate. So if you sort of look at the average, it's about 2 percentage points higher today than it was 5 years ago for somebody to renew, assuming they're sort of taking the same term and amortization, and sort of that all else being equal, that 2% increase. But the good news for them, that much maligned stress test, actually they were stress tested 5 years ago to a rate slightly higher than what they're facing today. So they're facing that sort of sticker shock, but it's something that they've already sort of built in as a contingency plan. They've been forced to build that in. So hopefully people can actually make those payments and they can just renew without, having too much trouble with them.
I think that's a really good point. Sorry, just we track that we're so aware at a given point in time of what that 5-year fixed mortgage rate is, but just because it went from 1.5, 1.6 in the spring of 2021 to over 5 today, there isn't anyone who renewed at that low rate for 5 years and is now renewing at this higher rate with that kind of a spread. So definitely rates are higher to Ryan's point, but we have to look back 5 years from today and consider those interest rates that were on existing or expiring contracts and what people are renewing at. And I think that's where, and then considering as well that, for those on the 5-year fixed terms, roughly 20% of them are renewing in a given year. So there's a little bit of a buffer. Not saying this isn't painful, but this notion of like homeowners flying through the turbulence right now, you sort of hunker down, and on the other end, you hope that interest rates aren't as high as they are now.
Yeah, and you hope that your income rose in the last 5 years, and it's a little bit easier to make those payments.
Exactly.
Yes, let's hope that. And I think just referencing back to our previous podcast that you just did, the Intel one, I think Ryan did a really great example of breaking down what those costs might look like for the rising interest. So
on the variable rate side.
On the variable rate side. So that's interesting. So for those listening who want to take a listen as to what Ryan's example was, that's a really great, interesting listen as well.
Yeah, that's a good point about fixed versus variable. Another thing we should probably keep in mind is that more Canadians are choosing variable rate mortgages than they ever have before. So today, for outstanding mortgage dollars, about 33% are variable, so it's still the minority, but that's up from 18% pre-pandemic. So almost a doubling of variable rate mortgages in the marketplace right now as a proportion of the total. And again, another way we can look at this, from 2017 to early 2021, about 20% of new mortgages were variable. And then from early 2021 to today, that's now 49%. So more than doubling the proportion of new mortgages in the last couple of years have been variable. And year to date, there's actually more variable rate mortgages advanced than fixed rate mortgages. Mm-hmm. So it's a bigger amount of mortgage dollars out there are variable, and we know that variable rate holders feel the impact of every single increase mm-hmm. from the Bank of Canada almost immediately. Their banks usually pass it on within a day. And so we know that they have to spend more money on interest every month. The cost of servicing their debt increases with every rate increase.
Yeah. So speaking of debt service, how are those numbers looking?
Yeah. So, I mean, the good news, if there is any on the sort of debt front and the debt service front, is that debt service ratios have been increasing. A debt service ratio is just a proportion of your disposable income mm-hmm. that you need to service existing debts you have. So some of those debts might be your mortgage, but then you also might have non-mortgage debt, and they kind of break it into two buckets. So the overall debt service ratio in Canada is just under 14%. So 14% of disposable income is being spent or being directed towards servicing debts. It's up a little bit recently, but it's down. It's still down from where it was 6 months ago. And the debt service ratio for mortgages it's relatively elevated, but it is below the previous peak that we saw from a couple of years ago. Mm-hmm. And then interestingly, the non-mortgage debt service ratio is actually near a 20-year low. So, Canadians, like, through the pandemic, with the building up of household savings and not having places to spend their money, as a collective, we're paying down some of those other debts and put themselves in as a group, we put ourselves in a pretty good financial position. Yeah,
and another one we can look at is the mortgage arrears rate, which is essentially the number of mortgage holders out there that are 90 days late paying their mortgages. And in BC, that's 0.11%. 11 out of every 10,000 mortgage holders in BC are 90 days late. And this rate has actually been falling. This is down from last year. It's down from a few months ago. Though we should point out this is kind of a lagging indicator because it takes 90 days for it to show up in the stats. But this is definitely one of those positive signs, one of those tailwinds for our market. So I think just kind of put this all together, it's sort of, what should we take away? It's that headlines really aren't everything. There's so much going on at the moment. We don't have to pretend to have all the answers, but we really want to emphasize, how important it is to consider really a wide array of different signals in our economy and our housing market, what they're telling us, where they're pointing us, because they're really pointing us in, various directions all over the place. And so we need to sort of evaluate each one and kind of put them all together.
So if we're being pointed in so many different directions, what are things that we really should be keeping an eye on?
Right.
Yeah. Well, I think we really should be watching the same things that the Bank of Canada is watching. Almost everyone is watching the Bank of Canada right now. What are they going to do? What are they going to do on October 27th? What are they going to do in December? What are they going to do in 2023? But let's watch what they're watching. They're watching the data, so are we. So what are the things that they're really focusing on? They're the same things that we're sort of looking at in the rennie landscape. So the things that are impacting our wider economy. Some really important ones they're watching is not just headline inflation, it's core inflation measures. So there's 3 core inflation measures. They're called common, trim, and median. They essentially, what they do is they sort of strip away outliers, those things that really fluctuate a lot in price, and they look at sort of the more stable goods and services to see what's happening with the more stable prices any month to month, and those only just started to fall month to month in August. So they're watching that. They're watching inflation expectations. And that can signal the potential for inflation to become entrenched. Inflation expectations are incredibly high right now. 78% of Canadian businesses expect inflation above 3% for the next couple of years. That's doubled in the last year. That's far above what the Bank of Canada wants. So they're watching that. And then I think the other big one that they really want to watch is the labor market. So, we can't put enough emphasis that the labor market's in a good place today. Overall unemployment's really low. It's pretty tight out there, but there are issues with job vacancies that can translate into higher wages, which again is mostly a good thing for people, but it can feed into inflation. It's there's a bit of that give and take. And so I think overall, what are we keeping an eye on? Well, I think the Bank of Canada will do another rate hike on October 27th. Why do I think that? Well, they told us that's what they were going to do. I'm not looking into a crystal ball here. And so, that I think that's something to expect. And, there's a few other things to keep an eye on as well.
For sure. Yeah, I think we can expect rising rates at least through the balance of this year. But you talked about the labor market. We've talked about unemployment and how low it is. That's something else we're going to watch, because there is an empirical relationship between, like, an observed relationship over time between the unemployment rate in this market and the amount of housing inventory or housing supply. And so essentially the way it goes is, when the unemployment rate declines, so does inventory. When the unemployment rate rises, inventory rises. And the most plausible explanation for that really is that you're going to see rising supply, more homes available for sale when there are fewer people engaged in the labor market. When fewer people are working than is ideal. So if if your income stream runs out, you might be inclined to try to get out. You might pay off other debts first, or I should say, sell off other assets first. But at some point, you may be forced to sort of get out from underneath your existing mortgage. And so, to the extent that we do see the unemployment rate start to rise, we could see housing supply rise, and that could translate into a protracted period of softened prices. I think we could use more supply. We're still 20% below what is typical for this time of year, and it's kind of been that way for months and months. But that is something that might signal a more drawn out downturn in our market. So certainly something we're watching. And then in the new year, there's a slew of government policies coming into play. When the market gets overheated like it did over the past year and a half, and like we've seen in the past, governments feel inclined to do something about it. So there's a slew of policies that are coming into effect in the new year. One of them is a foreign buyer ban. I called it a tax in earlier discussions. But the federal government will be banning foreign buyers. So it's a bit of a different definition of a foreign buyer than we have here in BC currently, where foreign buyers are taxed. But there's so many exemptions to it. It's such a narrow definition. It's not really going to move the market at all. It's more closing a loophole, if anything. We also have in BC a cooling off period that's coming into play that essentially really only applies to situations where there's a subject-free offer that is made. So if there's a lot of demand for one particular home, a lot of competition, emotions get involved, and people sometimes do something like they shouldn't do or that they regret later, i.e. put in a subject-free offer that they can't turn their back on. And so this just gives individual buyers a little bit of breathing room. And so I think that's something to applaud at the sort of individual buyer level, but not going to move the market. And then, lastly, federally, there's an anti-flipping tax that's being implemented as well, which basically seeks to discourage investors essentially from buying a home and then just reselling it within a 12-month period, taking away or eating up an opportunity for somebody who would like to live in that home.
Again, with a lot of exemptions on that one.
Totally.
So a lot of things that you've just discussed right now, apply to more of the immediate term, but what about the long term?
Yeah, and this is where I think we're going to sort of repeat ourselves from last time. When it comes to the longer term outlook of this market, a lot hasn't really changed. And I think we sort of see the fundamentals as still being there, the same ones that we saw 6 months ago. And I think that always starts here with immigration. International immigration to Canada is incredibly strong this year. The federal government has increased targets to make up for shortfalls in 2020. The last year was a record year for international migrants, not just in terms of permanent residents, but in all different categories of new international migrants. So we have 6 months worth of data so far this year, which is almost 700,000 newcomers. For context, last year, the whole year was 1.3 million, a record year. And potentially we're on pace, if you do the math. Most migrants actually come in the second half of the year, especially students in September. So if you look at the math on historical context, we're potentially on pace for 1.8 million additions to Canada, which is incredibly high number. And again, a huge amount choose to live here in Metro Vancouver and in BC. And again, that really speaks to the longer term demand in this marketplace.
And I think it's worth pointing out too that the reason that Canada is seeking so many newcomers and welcoming them with open arms is to help sort of grow the economy and allow Canada to continue to prosper. We have a significantly aging population and an increasing number of retirements every year as the baby boomers exit the labor market.
Look at those job vacancies. Right?
Yeah, yes. Totally. But anybody who comes here also needs to be housed. So there has to be some kind of balance that we need to find. But we certainly have a lot of people arriving. And then also, we were looking at net interprovincial migration. We've been tracking it since the beginning of the pandemic. And we look at net flows, so the total number of people coming to BC minus the number of people leaving, we're close to 60,000 people from other parts of Canada, which may not mean a lot on its own, but the second largest recipient on a net basis of domestic migrants in the country is Nova Scotia with 24,000. So we are just welcoming people from, and attracting people, I should say, from not just across Canada, of course, but around the world. And we need to figure out a way to provide the housing for them. So as we look ahead and specifically to the longer term, we're not soothsayers, and economists are terrible predictors of things. And if we made 100 predictions here today, we'd be wrong about 75 of them. But as we look out over the years and decades ahead, you look at sort of the demographic foundation that this region is built on and the expectations for growth, and then the historically strong economy and labor market, which is just continuing to expand. We feel really good about the prospects for prosperity very generally in this region going forward.
That's great, real great insight. So I guess in order for us to get more information, we need to get our hands on this little red book, eh?
Absolutely.
Definitely. So today on the podcast, we talked about how we got to where we are today, what it means when we say it's windy, and what we know about what's ahead. This wraps up this episode of the special Fall 2022 Landscape edition of the Rennie podcast. To dig deeper into the data, be sure to check out the Rennie Landscape on rennie.com/intelligence. Be the first to receive this information straight to your inbox and register for intelligence updates. Thank you, Ryan Berlin, Ryan Wyse again for your time today. I'm looking forward to chatting with you again soon for the spring 2023 landscape that will come out next year.
Thanks,
so
Justine.
Thanks, Justine.
Thank you.
Thanks, Ray.
Yeah.
Awesome.